In this video, I'm going to talk about in what situation you should stay away from trading when this similar kind of pattern happens. Sometimes you see while the stock is about to break out, it's the point when you can make some easy amount of money in a very quick amount of time. But there are some price action when this kind of similar situation happens, you should stay away from trading and you should exit as soon as possible. And also, sometimes while deciding whether you should get in to trade or not, when you see this type of situation happening, you should consider not bidding on that stock. That's why you can save yourself, like at least you can save to save one day trade. People who have a small account, who have less than $25,000 in their brokerage account, I mean their day trade is very important because they only got to trade 3 day trade on a 5 business day rolling period. So for a people with a small account, they want to make the most money out of that day trade because they only get 3 day trade on a 5 day rolling period basis. So whenever some newbie, especially new trader, make this kind of mistake, or it take them a while in order to figure out when to get in to trade in a stock and when not to get in a stock. So when you see the breakout is about to happen and the price movement is kind of stucking with in a price range where it has, if it surpasses those key mark point, it will be a breakout because it has some sort of indicator. And if it breaks out from that point, then the stock price would going to go, it's a breakout. And how far it will going to go, yeah, there are some kind of emergencies going on, the alarm is running. So they know, when some sort of uh, breakout from that particular point, if the stock price move the price further, then the stock would be a breakout. And how far the price is going to go, we don't know. Maybe it will going to stuck on the previous highs on an indicator level, or if it surpasses on a key level, then it may go very high on a very quick amount of time. That's when day trades got really like to trade in this type of situation, because when the price breaks up on the key level, it from the support and all the indicators from key level, it surpasses, then trader, like day trader, like anyone, they can make a quick amount of money in a very quick uh, short amount of time, and that's a very profitable strategy. But things to be aware of, like when you see the price movement, you can guess, you can uh, decide whether you want to get in to bid on that particular stock or not. If you see some stock price while breaking out, it has some sort of difficulty breaking out that key resistance level, where the stock, when it tries to break out from that key support level, it all the time coming back and forth, it bounces and it has some sort of difficulty breaking up that point. So that is the point when the breakout might not happen. And if you bid at that point, then the breakdown might happen and the price may move down very quickly and you may end up losing big. So that's how it's very important to get in to the right timing is the most important factor. One of the strategy I use when trading is like when it's about to break out from on a certain resistance level, and it has, if it has some sort of difficulty passing up, I set my prices. Let's say for example 434 is the point where if it breaks out, then it will be a breakout. But if it has some sort of difficulty, it bounces back, it keeps coming back and forth uh, randomly, like it just have some sort of difficulty breaking up, then I will not going to bid at that stock, because when the breakout happens, it just happens, it just break the key support level and it went high automatically. It just have no difficulty in breaking up that point. So that's the thing, if you see that kind of thing, like when it's breaking up and it's rising up and up and up and moving very fast, that is the time you should get in. And when you see that it has some sort of difficulty, it keep bouncing back, it coming back from the key support level, then you should not bid on that stock at that particular time, because it will going to fail. And when it fails on a breakout point, it really crashes big. And if you end up bidding on the peak of the price move, then you might eventually lose big. So that is the key. Like you see the price action, you see this thing happens, then you should consider whether you want to get in to bid on that stock and make a day trade, or you should not risking your money in order to get in. That is a very key important thing, because either two things going to happen: whether it would be a breakout, the price keep moving up, or it would be a breakdown, the price fail to break the key resistance level, and it will be a breakdown and it will crash big. So you don't want to bid on the peak of the price move, because if it break down, then you will be end up losing big, because it will lose 5, 10, 15, 20%. It will crash, and within a very short period of time. So that type of situation you should not consider even bidding. The strategy I used, when, let's say for example, it's a 434 mark, so I know if it passes 434 level, then it would be a breakout. But what if it does not break out? What if it fails? So when I see, like, I tend to bid like on the price mark, it's 434, but I set my price, let's say for example 440, because I know, if it passes 434, it will going to pass 440, 450, 460, 470, and it will going to be keep going up. Why am I, being bidding 440 even though it's traded on 434? It's very simple, because a lot of the time what happens when the breakout happens and then you decide to get in to bid on that stock and to participate on that trade, at that time, while you from your brokerage account you are giving the buy order, uh, like the amount of quantity you want to buy that stock, at which price you want to buy that stock, giving the order, limit order, to set all those key settings, to give order, it takes some time. And while you are bidding and calculating all those kind of thing, the price may be moving very up, then you end up bidding at a more higher prices. Maybe it will going to go at 480, then you would going to see, oh my god, I just gave like 436, I placed the bid, but it did not execute it, the price has moved up, way up, and you end up have to again have to bid again and waste your time. And by that time, if the breakout happens very strongly, you will again then going to take some time while bidding up and setting your price and setting up all the buy order. Then the price might have moved way more, like more than 540, way more than 480, then you have to end up bidding at higher prices. That's why I try to set the price at 440, even though when it's on 434, because I know, like, if it passes like 434 mark, it will going to move up if it the breakout happens. And if I set my price buy order at 440, then eventually the breakout will be happening, and my order will be executed also at the same time, and I will ride the momentum very quickly, and the price keeps going up. So that's the strategy, because I want to set my price at that point, because I know, like, if it passes like 440, it touches 440, then it would be a sure, it would be a breakout. So eventually my trade would going to be executed, and I will be participating on a trade which has already happened, a breakout pattern. That's the key thing of a breakout pattern, that I tend to use the strategy. It's very simple. And even though if it's not passing like 440, you are not risking your money, because if it fails, let's say it fails from 430, and it keep bounces back, and it keep crashing from that point, and it's tend to go down, then you set your price at 440, then the breakout never have happened. The price that you have set in order to the trade to execute, that price action have never touched that point. So eventually you are not losing your day trade, eventually you are not making a day trade, and eventually you set your price 440 despite the fact that it's a breakdown. But guess what, the price never crosses 434, I mean 440, and the price has not been executed, and it's a breakdown fail. And even though it's a breakdown fail, you set your price higher, it never touches, so it will keep going down. So eventually you will know it's a breakdown, it failed to break out, and you are not, I mean, making any trade, the trade has not been executed. And that's the thing, like, you have never risked your money, because I mean the price mark never touches that point, and the stock just keeps going down. So eventually you're, you're guessing, probably if it breaks out, it will be never touch at that point, and the trade will not be executed. So eventually you are not, you know missing out anything. The price action never touches that point, so the trade never happened, the trade never executed, and you don't end up losing one day trade out of that price action. So that is a key strategy for you to apply. Now, why you should apply that key strategy is very simple, because like I said, like when the breakout happens, the price tend to move very quickly, very up, and it takes some time to give the buy order. So eventually, you will you'll be thinking that if it crosses 434, then you will be get in, but the price will be moving very up very quickly, and by the time you set your buy order, you will eventually miss some of the price move and end up bidding at a higher price. So that's the thing. And if the breakdown, like breakout fails and it becomes a breakdown, and you set your price higher, the breakout never happened, it never touched the bid price that you have set. And if it crashed, then eventually it's not been a breakout, then no trade being executed, and you are in no harm, in no risk. So that is one of the key strategies that I tend to use, and that has been very helpful for me, especially to assure myself, if the breakout happens, my trade get executed. If the breakout fails, my trade will never going to be executed. And in this way, I like assure myself to set the price range, like the price action, at a price mark where I know that if it touches that, it will eventually will be breakout, it will keep moving high. So that's one of the key secret and key strategy you can apply, and you can be sure and assure that you will not going to lose if the bounce and bounce fails, if the breakout fails, there is no risk. So that's the key strategy you want to use, you should use, you should apply. And that's when you also saving one day trade. If you have a small account, if you have less than $25,000 in your brokerage account, then I mean the day trade, one day trade you get out of five trading days on a 5 business day rolling period, then you are not losing that day trade also. So that's a good strategy to apply, and to assure yourself, like, you are not, at least you are not losing. You're setting the price in a price mark, if it surpasses, it will be a breakout, and if it don't touches at that point, it will be a breakdown. And the price mark you have set, it never touches, your trade did not get executed, and you did not end up losing. So that's a key strategy for you to apply, especially on the breakout kind of thing. When you see the support level, the past indicator, and from that point, that is very important, it keep bouncing back, whether you should get in, whether you should not get in, whether it will be a break out, whether it will be a breakdown, you don't know, I mean, you're confused, the price action kind of confusing you. So that's the thing to apply. And also at the same time, when that is the tip number 2, when you see the price have some sort of difficulty, breaking up or breaking down, from a certain point that you know if it passes it will be a breakout. If you see that have some sort of difficulty, it keep bouncing back from that position, I will not trade at that point at all. I will not bid from that price mark. Is because if the breakout is happen, it will just simply blow it up, like it will just simply break the key resistance level and it will keep going up. So that's actually naturally happens, and when the stock actually fails to break out, it keeps bouncing up and down, it having difficulty to break that key uh, price mark, 434, as for example. It kept coming back, it have some sort of difficulty to pass at that price mark and to go up. Then at that point it will not going to be breakout. It will, I mean, it will crash. So at that point you should not bid at that trade, you should not participate in that trade. That's the two thing you should consider. And also, like for example, I mean, in the first tip that I have said, if you set yourself like 440 mark, I mean, if it touches then it will be a breakout. So you can also apply that uh, tips in order to set your price a little bit of higher price range while it was trading on the you know below that breakout point. So in that way, I mean, you also, I mean, assuring yourself that if you set the price mark on a breakout point, that if it don't touches then it will not be a breakout, it will be a breakdown, it will crash big, and you should not participate on that trade. And if it passes, then wow, it will be a breakout. So that's the two really 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 good advice, especially if you're a newbie. Apply that, it will be helpful for you. uh, Another thing, I mean, when sometimes you see the breakout happens, like let's say for example the breakout happened and it crossed, I mean surpasses 434, it even fulfilled your trade 440, then at 445 or 4450, after reaching that point, it's not going up, it's keep coming back down, it's keep coming back down, it's not passing up, it's not going up. However, it's kept going down. So at that point, it's very alarming. The price action is very choppy, and you should not participate on that trade, no matter what. You should immediately try to sell your, position immediately and get out of the trade, because otherwise, I mean, it will crash. And when it crash, it will crash big. You will lose big, because when the breakdown happens, it will crash 15, 20, 25% very within a very short period of time, and it will be keep going down. So when you see that type of choppy price movement happening, then get out of that trade immediately. The sooner you get out from that trade, the more money you will be saving, because the more time you will give on that trade, the more you will be losing. So the sooner you will exit out of that trade and get out immediately, the better. Even though you have to take 1 or 2 or 3% loss, it will be a good loss. Eventually you will loss less, you will lose less. So that's a very key thing to remember. I mean, you should, I mean, while trading, you should visualize. You should, I mean, you should have that sort of strategy ready. Like when the things is not happening the way you wanted, and when the things is, acting, not acting the way you wanted or the way you expected, then you should have your, second strategy ready to apply immediately, so that you can protect yourself, you can save yourself from that big loss. That is a very important key. Sometimes things might not go the way we wanted, but as a good trader, you should always have to have some sort of a strategy ready on your pocket. When things go wrong, immediately you should apply that point. Emotionally you will be like, sometimes you will be confused, you will be think like, no, I don't want to lose, I don't want to lose, I want to make money, things will change, like let's give some time, it will go up, let's wait for 1 more second, let's see, I mean, if the price keeps moving and give it a more chance. No, this type of thing is bad, like this type of thinking is bad, this type of mindset is bad. Because when you think like giving more time, you don't want to take loss, even though if you would have take loss, it would be like 1 or 2 or 3% loss. You wanted to give some more time. The more time you give, eventually, if even if it rises very, I mean, little bit high, then it will again crash big, keep falling. The more time you will give, the more bigger your loss will become. So the thing is, the sooner you exit out of that trade, the less, I mean the more you will be losing less. That is a very important thing to remember, to be focused, to be emotionally like uh, aware. Like when things turn into this type of situation, immediately you apply your strategy. Don't be misled up with your emotion. Don't be distracted with any sort of emotional thing, whatever it's telling you. I mean, while trading, if you're trading, like especially on the penny stock niche, you have to apply your strategy when things turn against you. And that is a very important thing while trading, because penny stock niche is very risky. People lose a lot of money and people also make a lot of money. Things to be successful on the penny stock niche, all it takes is discipline. People who care less about emotion, people who they don't get distracted with their emotion, they immediately apply what the strategy that they have on their mind, or they know that things, if they apply those type of strategy, it will going to save them, I mean, from losing less, I mean losing big, or making money. They just apply, they just don't listen to their emotion. Whatever the emotion tell you, they are very strong, to react and act immediately. They act immediately. While new people, new trader, the loser, they end up distracted with their emotion. They think like this, like, I don't want to take a loss. They become stubborn. They give some more time, and they see like, give some more time, like, uh, I don't want to take a loss. I don't want to take a loss. I will give some more time. I will wait. It will recover. It will recover. I know it will going to recover. Let's give some more time. I mean, the price action, it will going to go up, even though it's going down. I mean, it will cover. And while it's go up a little bit, they know, oh, it's going up, so let's give some more time. That's a very bad mindset. That's a very bad mindset. The early, the sooner you will exit, the less loss you will be having. The more time you will give from that type of situation, your loss will eventually go more bigger. And that is not healthy strategy, to be honest with you. So uh, be strong enough to not be distracted with your emotion, to be strong enough to apply your strategy, even though your mind or brain is telling something, even though your emotion get into your way, even though you have to take a small loss, apply that strategy. Even though you have to take a small loss, apply as quickly as possible. That is the main thing. That is the key thing that set the difference between a good trader and a bad trader, between a experienced trader and a new trader. New trader and bad trader get distracted. They become stubborn. They don't want to take loss. Good trader act immediately. They react immediately, even though whatever their brain said, they don't listen to their emotion at all. They just apply their strategy, and they don't even get worried or bothered or feel bad about, even though they have to take 3 or 5% loss on that trade, because they know, even though they are losing 5% or 3% on that particular trade, the next trade they will be making money, and they will be making like 10% or 7% money or 15% money, and they will going to recover that loss. Trading is a continuous journey. You make your account big over time. It doesn't happen in 1 day, 2 day, 3 day. It takes time to grow your account. You have to be disciplined, and like consistency is the key in trading, while minimizing the loss and maximizing the gain. When losing, they lose, good trader they lose less, and when gaining, they they gain. They not necessarily, I mean, are, very greedy type of mentality. They don't think like, I have to bid on the bottom of the price move and I have to exit on the top of the price move, and I want to take all the price action of the price move, and I want to take the most out of the profit. They don't think it like that way. They take 5%, 10%, 15%, 20%, depending on the price movement. And even though they know they could eventually make more money if they could have waited and give some more time on that particular trade, but that doesn't way I mean that's not the way they think. Even though they know that they could have made more money if they wait, but they take their profit, even though they could eventually make much more. Like, let's say for example, if like if someone make 10% out of money, they eventually know they could have made 20, 25, or 30% out of that price action. But with 10% gain, they exit out of the trade, take their profit, and they are still happy, because they know it's a continuous thing, it's a continuous process. And if they consistently win more than they lose, that's how they make their money. So that is the key mindset while trading. That is very important. And that's the thing. Uh, the trader and a good trader, they win consistently. They, even though sometimes they lose, but they, when they lose, they make their losses small, and when they gain, they make their gain go bigger. So that's why they are, they win more often than they are losing. And when they are losing, they are like, exiting out of the trade. They keep their losses small, and that's why their gain becomes bigger than their losses. And their account keeps growing over time, because of the discipline, because of their strategy, because of their mindset, and because of their uh, I mean because of this sort of mentality in trading, and applying that strategy, keeping stick to that type of strategy, and that lets those good traders account to grow over time, you know on a gradually, on a consistent basis. So that's the main difference between a good trader and a bad trader. How bad traders see things, how good traders see things, how bad trader fail to strategize things, how good trader uh, be successfully strategize things and act on it immediately, quickly. So that's the key thing that set apart from a good trader to a bad trader. And people who become successful in stock trading, especially on the penny stock niche, it takes very, self-discipline, good mindset, and less emotion into trading. All they care about is the you know price action. And when things go against them, or when things go it's not going the way they wanted, they immediately apply the strategy that they have learned over the years, that keep them safe. And they act very quickly, they act immediately. They don't get distracted or emotional or greedy or stubborn, not taking loss type of thing. They take loss, but they take small loss. So that's the mentality of a good trader. And I hope this video helps you to strategize things while your trading journey, and you become successful as a trader. And make money on a consistently, on a regular basis, and become successful. That's what I want. That's why I'm sharing this video. So that's the thing I just wanted to say. I would like to thank you all. It's very, night. I'm sorry that I'm making the video in this night time, because in the daytime I'm doing a full-time job. I don't get time to do that video. So while coming back out of from office, so I wanted to make sure that I make a video, so that some people can see and strategize things differently, and help them to grow their account, to become successful in trading. And that's that's the thing. So I wish you good luck, and thank you so much for seeing the video. Thanks.